The US government just gave us a major update to its labor market data, and it's as bad as we were expecting. Coincidentally, on the same day, retail giant Target just reported nasty results and a grim forecast, which sent its shares plunging by 20%. Now, these might have been coincidence as far as their timing, but the two of those are very much related. The BLS updated its qcew, or quarterly census of employment and wages for the second quarter of this year. And what that showed was what looks every bit like the labor market heading toward a recession even before we got to the summertime. Remember, that's just what so much other data has been saying this entire time. Now, the qcew is the gold standard for labor data, the biggest sample size, the most robust procedures, the whole 9 yards. Payrolls are even benchmarked to it for this very reason. And the BLS has already admitted that payrolls are overstated, and that's only through March. So we're talking even worse in the second quarter, which means a few of those summer jobs numbers that we've been talking about recently were almost certainly negative, August for sure. So is it any wonder that Target is in real trouble? The company said they lowered prices, and for a little while that brought shoppers back in, a few of them. But then despite lower prices and cutting them a whole bunch more, Americans just weren't buying in the third quarter. At the same time, of course, Walmart is booming, with all of Walmart's growth coming from higher income shoppers. The whole economy is indeed falling apart. They keep saying consumers are resilient. The labor market is holding up. Nope. Both Target and Walmart together show there's real trouble brewing. Even the payroll numbers were weak heading through the summer. And now with the qcew, it all really falls into place. The labor situation was even worse than it already appeared to be. This isn't about prices anymore. It's about jobs and especially incomes. And here we have it from both sides. We have workers and we have consumers. We have spending and we have retailers. All of it lining up in exactly the way that we've been saying all along, because summertime really was the time for recession. So let's start with Target. Go back to the summertime in August. Target was relatively not quite optimistic, but less pessimistic than they had been heading up to that point. When they reported earnings in August for the second quarter, they actually raised their guidance for the third quarter. As Reuters reported, Target raised its full-year profit forecast and reported its first increase in quarterly comparable sales in over a year, driven by price cuts that attracted more shoppers to its stores. Target's results reflect a similar strategy employed by Walmart and other retailers looking to attract increasingly price-sensitive consumers. It's not really about prices, it's about incomes. It shows that U.S. consumers are constrained, but not in recession mode. Famous last words here. They're holding out for deals, but have some financial flexibility, at least according to analysts and industry watchers, what they said at the time. Fast forward 3 months to the earnings report from the third quarter, and Target takes it all back. They even said they regret raising their guidance because it was the wrong thing to do. While there was some initial response to the price cuts, as you would expect, it didn't last because the summertime got worse. According to CNBC just today, the company's shares plunged more than 20% in morning trading, hitting a 52-week low. Chief Operating Officer Michael Fidelki said, "It's disappointing that a deceleration in discretionary demand, combined with some cost pressures, have caused us to take our guidance back down after raising it last quarter." But he added, Target feels confident in its long-term outlook, just in the same way they felt confident about the current quarter 3 months ago. Of course, he's going to say we're confident in the long-term outlook, just overlook the mess that we're in right now. Companies are always going to put a spin on everything. According to Bloomberg here, Target Chief Executive Officer Brian Cornell tried to downplay the negative results, noting that issues like the port strike were a one-time problem and that the company's early read on holiday sales were positive, just like their early read on the quarter were positive too. He said the company's working to respond to weak demand and offset higher costs, but that it made the right decision to stockpile goods ahead of the port strike just in case it went on longer than expected. And Target incurred an inventory charge because the port strike didn't last very long and they over-ordered. And this is, by the way, something we're seeing across the economy, where you see the goods economy tailing off at the end of the year because so many companies like Target were over-ordering in anticipation of not just the port strike, but also in response to the Red Sea logistical issues that came up with that. In other words, a lot of demand got pulled forward into the first half of the year, meaning the second half of the year, as far as producers are going, it's not going very well, which we talked about in some of the recent statistics like industrial production. But as far as consumers goes, that's where it all comes back to. They may have over-ordered on inventory, but a lot of it is because they were expecting to sell it out over time. And now what they're saying is we don't really see a pathway to do so. Back to CNBC. To woo price-sensitive consumers, Target announced back in May that it would cut prices on about 5,000 frequently purchased items, including diapers, bread, and milk. It announced another wave of price reductions in October on more than 2,000 items during the holiday season, including cold medicine, toys, and ice cream. Not sure why you need ice cream during the holiday season, but why not? Yet, here's the thing. These price reductions weren't enough to lift Target's performance in the fiscal third quarter. And you look at Target stock, and it looks just like the supply shock trend and pattern. There was huge run-up in shares to a ridiculous, absurd record high in 2021. Everybody thought that it was a permanent plateau of prosperity and that retailers in particular were going to benefit for the foreseeable future. Then suddenly, middle of 2022, everything changes. Got the technical recession in the United States. And Target stock, like its business fortunes, continued to fall all the way through late 2022 into 2023, only to turn around late last year on the disinflation rebound, lower interest rates, the idea that consumers were now, with less price pressures and lower interest rates, because we always think interest rates are the most important factor, that was going to lead to a renaissance, a resurgence in consumers and spending and retailing and everything else. But the Target stock, like the economy, peaked in March. And the stock was only slightly lower through the summertime and basically sideways for several months before finally falling off a cliff as reality, the summertime reality, catches up to Target here heading into the end of the year. So it's just like the supply shock. It looks a lot like the US dollar exchange value. So as Target stock fell through the middle part of this year, that was on recognition of growing weakness, but also the hope that the U.S. consumer would indeed pull through for the rest of the summer, because the employment data didn't look all that bad, especially the September number. Now we find out that the employment statistics were, as we've been saying, worse than we even thought heading into summertime. All of it begins to make more sense. The labor market, jobs, incomes, uncertainty, pessimism. Of course, as Target has suffered, that usually means Walmart gains. And Walmart has reported pretty much blowout earnings and revenues and everything else. Also this week, Walmart U.S. sales at stores open for at least a year grew by 5.3% last quarter compared with the prior year. That's what the company said on Tuesday, and its profit grew by 8.2% last quarter. Walmart even raised its financial outlook as Signal expects a strong holiday shopping season for them, only because it's not strong anywhere else. And that's always been the thing with Walmart. When Walmart does well, usually nothing good is happening in the real economy. Walmart said it gained market share last quarter, driven, quote, primarily from upper income households. Households making more than $100,000 a year counted for 75% of the company's gains. So even higher income consumers are worried about jobs and income on top of the lost purchasing power that they suffered over the last several years. It all adds up to the downside of the supply shock. And the other side of that downside is the labor market. It is not strong and robust. Americans, as workers, they feel that it is indeed weak and that it is not strong and resilient. And that's more than likely it is getting worse, not hanging in there, not stabilizing, nor certainly not increasing and rising and accelerating and moving off into a soft landing. We've seen a bunch of indications and data for this summertime stumble pretty much everywhere, including, as I pointed out, with the payroll report for October. It wasn't about the October number, which was low, and I'll get to that in just a second. It was about the revisions to the summertime, the revisions to the establishment survey before we even get to the qcew that showed there was a substantial slowdown during the summertime. We already knew that. We could see it coming. A whole bunch of other statistics and accounts and stories and anecdotes had picked up on it. Now we have maybe the biggest one of them all. Unfortunately, it only goes up till June, sort of leaving us on a cliffhanger. But what a cliffhanger it is. I'm talking about the qcew, the quarterly census on employment and wages. Remember, payrolls have been overstated because the qcew started to soften last year, as I pointed out before. What we just got today is the qcew estimates for the second quarter. So that's April, May, and June. And June's the one we're really focusing on here. So what it showed was that job growth may have steadied a little bit in the first part of this year, which is consistent with some other statistics and accounts, around March, April, and May, with April and May being the new data that we just got. But then in June, it slowed way down. I mean, way down. According to the latest results from the BLS, year-over-year change in the qcew was just 0.8%. That is not only a big deceleration from the couple months before then, it is also the lowest that we've seen outside of 2020 since 2010 and 2011, which was the economy and labor market struggling to get out of the Great Recession. Looking at it from the other perspective, going into recession, 0.8% is around where the qcew was, and therefore the establishment survey after benchmark revisions, in late 2007 and early 2008, heading into the first part of the Great Recession. And remember, these statistics only go through June. This is just the second quarter. So leaving off in June, the slowdown in the labor market was at levels that we saw and associate with recessionary periods. So like I said, it corroborates all the other data that shows the economy and the labor market in particular did indeed stumble badly around June. And while the qcew only shows 1 month at 0.8%, as you can see in the data, we don't get a whole lot of variation. When it starts to go down, it goes down and it continues to go down into the recessionary periods. So not only does that corroborate all the other data that we have, it means that once the establishment survey payroll estimates eventually get benchmarked to the qcew, though we won't know this until a year after next March, so we're talking about more than a year away. But what that means is that, as I pointed out, the payroll data that we got during the summertime, August for sure was almost certainly negative. I mean, almost positive August was negative. Maybe some of the other numbers are negative too. And even October, when you take out all the storm and strike factors, which was already weak to begin with, October's likely to end up being negative as well. So the labor market is much weaker than anybody appreciates because there really was that downside of the supply shock accelerating in the middle part of this year. It's the trend that matters in the qcew, and it's pretty clear where this trend is going. Just ask Target. We also got a report on the state level data from the BLS, so we can go back and make a little bit more of a granular analysis of the October payroll report, because a lot of people say that was just storms. The weakness there was all about hurricanes and the Boeing strike, and there's absolutely some truth to it. According to the state level payroll data, payrolls were down 38,000 in Florida, so there's your hurricanes, and another 35,900 in the state of Washington, so there's your Boeing strike. But things were not going all that well in Florida, nor were they going that well in Washington before October. Not only that, when you look beyond these one-off factors, October was not going to be a good month anyway. The hurricanes and the Boeing strike just made it worse than it would have appeared anyway, especially before we get to the qcew benchmarks. But October wasn't going to be a really good month to begin with. And we know that for a couple of reasons, including the fact that, according to the latest data, payrolls were down, which means negative. They were negative in the month of October in 29 states. More than half of the states saw payrolls decline in October, having nothing to do with hurricanes or strikes. That's the biggest number of states showing a decline outside of July 2023 since 2020. So weakness was indeed widespread. It wasn't just hurricanes. It wasn't just the Boeing strike. And the QCEW report shows that the labor market was in serious trouble and heading that way. The trend was in the wrong direction, moving more like the household survey, even before we got to the summertime. The establishment survey looks weak to begin with in the data that we have and the estimates that we have now, and we know it was even weaker. And of course, all of this goes along with recent statistics we got on retail sales and industrial production. Retail sales, despite mainstream opinions that it shows strong and resilient consumers, just ask Target about that one. The year-over-year change in nominal retail sales, under 3%, in the danger zone, consistent with everything we're seeing here, especially jobs and incomes, and what's showing up or not showing up in Target's quarterly report. Shoppers aren't just pressured by prices. They're pressured by incomes. They're worried about their jobs. We've known all along that employers have been trimming costs. They've been cutting back hours. The hiring freeze, which is the other part of this labor market data weakness, is the fact that companies are not hiring. So you got companies that aren't hiring, maybe some that are firing, especially in more than half of the states, and that's in the month of October. We got massive weakness heading into the summertime. Of course, these are the results that we're going to get from them. So the labor market data confirms what we're seeing in income. QCEW confirms everything we've seen in the labor data and then goes a step further. It's not just what Target is saying. That's just the real world anecdote that lines up with everything else. So we knew the U.S. economy was in the recession danger zone even before we got to the summertime. Now we have Target telling us about the third quarter and looking ahead into the fourth quarter, plus a big one, QCEW, even if it's only up through June, both of those confirming everything that we've been saying. Labor market was heading in the wrong direction. There really was a summertime stumble because summertime is the time for recession. Target and the QCEW really drive home what we're already seeing in retail sales, industrial production, and other economic accounts. Went over those two, retail sales and IP, in the video link below. As always, thank you very much for joining me. Huge thank you, Eurodollar University members and subscribers. And until next time, take care.